Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the changes to retained earnings and how our statement of retained earnings is affected by a series of special transactions or decisions that a company can make. We've already talked about changes in estimate and how they flow through this year's net income and closing entries to change retained earnings. We've talked about changes in principal and how they change earlier retained earnings numbers and this year's numbers. We've talked about changes in entity, or at least a portion of them, and how transferring stock out of equity classification changes net income, changes retained earnings through changes in this year's net income. We've also talked about how transferring into equity changes retained earnings because it also causes some differences in our net income. The last thing we need to talk about are changes in retained earnings because we've made mistakes. So let's jump right into that discussion. One thing we need to be clear on is the fact that all companies make mistakes. Some of these errors are so small that we don't care about them. We call those immaterial errors, and we just kind of ignore them on our financial statements. Auditors find them and now have to at least tell the board about them and disclose them. But if they're immaterial, meaning they wouldn't change the decision of a normal, rational investor, then if the company chooses not to record them, they don't have to. They often do because it really doesn't change the decision, but they don't have to. Sometimes, though, these errors are really big. Then they do require an adjustment. The big thing to remember here is that if we're talking about a multi-billion-dollar company like Walmart or Target or Boeing, etc., there are going to be mistakes. There's just too much going on for us to get absolutely everything right. So the question is, how do we fix it? Well, first and foremost, we have to decide, was this intentional or not? If it was intentional and we misled investors, then we're dealing with fraud. And fraud needs to be prosecuted. It needs to be brought to the SEC and the PCAOB, and then they help decide how the changes are going to be made. If it's not intentional, if it's just a legitimate mistake, then we need to just fix it. And we just fix it ourselves. We work with the auditor and we get it taken care of. And how depends on what kind of a mistake it is. There are two major classifications here: counterbalancing and non-counterbalancing. And those are just fun words to say. That's my favorite part of this lecture, is talking about counterbalancing and non-counterbalancing. Why that tickles my funny bone, I don't know, but I love saying those words. Counterbalancing means that it's going to fix itself. If you just leave it alone, it will be right after a couple of periods. So let's take, for an example, an error in estimating ending inventory. If you miscount ending inventory and you're too high by $10,000 this year, ending inventory will be too high, which makes cost of goods sold too low. If cost of goods sold is too low, then net income is too big. If net income is too big, retained earnings is too big. But then we get to the next period. The next period, beginning the inventory, is now too high. If I do everything else right, then cost of goods sold will be too high by $10,000, which means my net income will be too low by $10,000, and my retained earnings at the end of that second year will be right. It will have fixed itself. So if we think about this, inventory and retained earnings, in year one, inventory was too high, and retained earnings is also too high, $10,000 each. If I don't make any mistakes, then in the next year, my inventory will be correct. I'll have an extra write-down of inventory, so cost of goods sold goes up because inventory goes down a little bit more than it should, and my mistake balances out. It's gone. I've got the right balance now. In retained earnings, I'd have this extra cost of goods sold would drop retained earnings by $10,000. That's $10,000 here as well. So by this point, retained earnings is 100% correct as well, because the errors have balanced out. Again, we call it counterbalancing, because if left alone, the errors will simply sort themselves out. The rule then is, if you don't catch a mistake and it's counterbalancing and the 2 years are up and inventory is now correct and retained earnings is now correct, I don't do a thing because it's fixed itself. So it's done. If they're counterbalancing and I catch it in the middle of the second year, it's going to fix itself, but it hasn't yet, then the rule is that I go ahead and fix it. That way my numbers are right. So again, if I catch a counterbalancing mistake before it balances out, then I fix it. Other mistakes are what we call non-counterbalancing. Non-counterbalancing errors will never fix themselves, ever, which means I have no choice. When I find them, I gotta fix them. So a great example of this would be I declared a dividend and paid it, and I forgot to do the journal entry for it. There is no way that will fix itself. That cash is not there anymore. Retained earnings is too high. Some point, I'm gonna realize that cash doesn't balance out right, and I need a journal entry. So I'm going to have to make a correcting entry to fix that error. So whenever I find it, I fix it. Now, because I only correct some counterbalancing errors and have to correct all non-counterbalancing errors, the difference between these two is really important. So it's one of our key concepts to understand the definition of the two types of errors and how they affect the journal entries that are coming. So make sure you're comfortable with that. Now that we've talked about counterbalancing and non-counterbalancing, we can talk about the method for correcting errors. So step number 1, decide if the error needs to be corrected. Again, these are non-counterbalancing, which always have to be corrected, or counterbalancing that haven't counterbalanced yet. If a correction needs to be made, then we move on. If it's counterbalancing and it has fixed itself, we don't go any further in the steps, we just leave it. But assuming an entry needs to be made, we then write down the incorrect entry that we did. Then we write down the entry that we should have done. Then we start looking at the two sets of entries. We figure out what accounts need to be changed to move from what we did to what we should have done. Then we figure out the amounts and whether they're debit or credits to fix these accounts. Once we know the accounts and the amounts and whether they're debit or credit, then we can make a correcting entry. And finally, we can correct the statement of retained earnings. And of all the changes we've talked about so far, this is the one that has the biggest effect on retained earnings. Not because the amounts are necessarily bigger, but because they're more scrutinized by investors. They want to know that we've made a mistake and how we fixed it and will it happen again. So of 4 changes to retained earnings we've talked about, this is the biggest issue for us. And the best way to learn about it is to do an example. So let's jump right in to Daglin Incorporated. The audit recently found that the company missed some interest expense in year 2. So we had this $100,000, 6% 4-month short-term note. It was issued on December 1. It's going to be paid at the end of March. And we did not record anything on December 31st of year 2. Should have, because a month's worth of interest had accrued, but we didn't. Instead, we just got to March 31st and we recorded all the accrued interest and paid the cash, and we were done. So we want to know what journal entries would we need to make if the year 3 books are open and if the year 3 books are closed. And our very first step is deciding, do we need an entry? Well, let's think about this. If I don't record an interest expense in year 2, but I record all of the interest expense in year 3, this is counterbalancing. It would fix itself. All of the cash has really been paid and recorded. All of the interest expense has been recorded at some point, and the interest payable either wasn't created or would be closed. Everything would have worked out. So this is a counterbalancing mistake. Perhaps another way to see this is to actually look at the amounts. Sometimes that can help a little bit. So let's figure out how much interest they should have accrued in December. So it was a $100,000 note. 6% interest, and interest rates are always annual unless they say otherwise. So $6,000 annually, 1 of 12 months has passed. So I should have recorded $500 worth of interest in year 2. I didn't. I missed it. So if I don't record an interest expense, then interest expense goes down. So net income goes up. So retained earnings goes up as part of those closing entries, or at least it doesn't go down as far, however you want to say it. So at the end of year 2, retained earnings is too high by $500. So now we get to March. In March of year 3, 4 months have passed. I record $2,000 in interest expense. Shouldn't have. I should have only recorded 500 times 3. So 1,500 total. So in this case, in year 3, interest expense is too high, which means net income is too low, which means retained earnings will drop by $500. Let's see, an increase of 500, a decrease of 500, the net effect is 0. Therefore, it's counterbalancing. So the question is, do I need to make an entry? Well, if year 3 is closed, I finished year 3 and I'm into year 4, then I've already recorded all $2,000 of interest. It's counterbalanced. So if I find this in year 4, I don't need a journal entry. If, on the other hand, I find it in year 3 and the books are still open, then I'm going to go ahead and make a journal entry to fix it. The answer up here, if the year 3 books are already closed, the journal entry is no entry. Now, while that's easier, it's not very exciting. So I want to move right into what happens if year 3 is still open, and I can make a journal entry and fix this and show my investors correct numbers. But we're not going to do that now. We've gone a little long, so we'll do it in our next segment. I'll see you then.